The stock market has been booming. Like the stock I told you all about at $12 just 3 months ago is now up over $36, which is a 367% gain this year to date. You would have tripled your money getting in after my video. With a booming stock market though, there is definitely growing concern about an AI-driven valuation bubble. The US federal government shutdown is disrupting economic data. The stock market took a little dive after big expectations from Powell this Thursday, and then just yesterday on Friday, President Trump threatened massive tariff hike on China over rare earths dispute. As soon as that happened yesterday, I broke the news on my exclusive group Patreon and let them know that this is happening and what I'm gonna do about it. By being a part of that group, you get an update just in time, like right when it happens. It sends an email alert to your email. And for this one, I told them what I'm buying at exactly that same time, so if they wanted to check that out for themselves, they could. The link to my Patreon group is down below. In this video, I'm going to go over all the things that I just introed with, and also we have a huge event coming up that could make stocks boom even harder, or we could see a huge crash because of this. I'll also answer this awesome question today from one of you who asked if I'd be able to comment on the gold rally. And boy, do I have a treat for you. Gold's all the rage right now, but you might want to consider a couple of things. Okay, so first, Bloomberg put this out, saying that this is how the AI bubble is forming. As you can see, Nvidia is at the center of everything, but one big thing to point out and to keep an eye on is the cycle that seems to be forming where the money's floating from one company to another and then back, and each time it makes big news, which then increases the specific stock, and then rinse and repeat to keep driving it higher. A bubble like that is very scary. So I dug a little bit deeper, and I'm not so sure that that's the full picture. In the late 1990s and with the dot-com bubble, that bubble was brought on by pure speculation and hope alone. This AI situation is actually quite different. Don't get me wrong, there's absolutely much speculation in certain specific companies, and certain stocks are way overvalued and you absolutely should not be touching those right now. The sector as a whole absolutely has very much merit as to why it's valued in the way that it is. The AI bubble worries are rising. The number of news articles mentioning tech and bubble has climbed, as you can see here. And looking here, the thing that is driving the stock market right now is none other than big tech. Nvidia and Microsoft are outpacing much and beating the NASDAQ 100 and S&P 500. The thing is that Goldman Sachs strategist Peter Oppenheimer says that it's a bit too early to be worried about a bubble. He said the record-breaking rally in tech heavyweights has been accompanied by robust earnings growth. In past bubbles, the market was driven higher mainly by speculation. Valuations of the technology sector are becoming stretched, but not yet at levels consistent with historical bubbles. So he said specifically that a handful of tech giants, including Nvidia, Broadcom, and Microsoft, have driven US stocks to record highs as investors bet on sustained earnings growth and improved productivity from AI. Now, something to keep in mind is valuations are also on the rise. The NASDAQ 100 trades at 28 times forward earnings compared with a 10-year average of 23. Goldman's Oppenheimer said bubbles tend to develop when the average value of companies soars beyond implied future cash flows. This time around, he said, the best performing tech stocks have unusually strong balance sheets. So yes, a lot of these valuations are kind of crazy, but then when the earnings reports come out, it's showing that their numbers actually match up to the value, or at least are getting closer to it. The balance sheet is a very important thing to look at to make sure that we're not overpaying for a stock that might be too crazy at this point. Still, the strategist reiterated his recommendation that investors seek diversification to avoid risks around a narrow US stock rally and higher competition in the artificial intelligence space. This is exactly what I've been talking about for the past 6 months, honestly. So let me explain what I'm doing to invest with much downside protection while also getting that upside possibility. And I personally use investing.com to research and figure out all this AI hype. This video isn't sponsored by them, so don't worry, it's not an ad, but I just wanted to show you the tool and how I use it. There's literally 1,000 things this site does, and it's where I start my research for sure. So if you want, I do have a discount code below that gets you not only 50% off, since they do have a pretty big sale going on, but also an extra 15% off with my code only. Again, not a sponsored video. Check out the tool if you'd like to, but it's where I start my research. Okay, so let me touch on that question about the gold rally from before, and then I'm going to get into the news for this week. So can you comment on the gold rally? If I showed you a stock, something like Palantir, and I showed you a chart like this that shows some crazy growth, specifically this year, like when we look at the 1 year, it's up over 330% in a year. Crazy. Even if you understand the company and you expect them to keep growing or at least grow more than they are at today, right at this exact moment, it's probably not the best time to dump all your money in, right? Like, it's not a great idea to jump in after the company has had the huge run up. You may either want to wait for some type of a pullback, and possibly that's going to happen, or at the very least, just jump in very slowly. So if you had something like $10,000 and you've decided that that's where you want to put that money into that stock, why wouldn't you just put like $500 per month in there, slowly getting it to that $10,000 eventually, but dollar cost averaging along the way just in case there's a really big dip? Well, gold is all the rage right now. Let's look at the chart. Year to date, it's growing and has grown like crazy. Looking at the all-time chart, this looks familiar from before, right? Look at the insane growth, particularly in the past year or two. The run-up is and already has happened like crazy. And the actual numbers are here. In the past year, it's up over 52%. But let's look at the history. From 2004 to 2024, the period showed an average annualized return of about 8.4%. In the last 10 years, gold returned around 5.5% per year. This was especially interesting here. In the 2000s, gold experienced a significant upward trend, especially around the 2008 financial crisis. Right now, we're experiencing a totally different type of crisis, and that's why we're seeing the same pattern repeat. It's surrounding this idea of the de-dollarization and possible trade wars or tariff situation. I would expect that with these new threats of the tariffs in China, that if that actually happens and if Trump's threats actually come through, we're going to see gold probably go up even more in these next couple of months. The deal is that in times of crisis or uncertainty, people turn to gold, but also blow it out of proportion. Gold is a solid asset that has held up and stood the test of time. But you need to remember that it's one that's going to, yes, beat inflation, and it's a solid asset because it continues to appreciate, especially as the dollar loses value or inflation eats it up. But you don't invest in this necessarily to get rich. It's not really about wealth growth, it's more about wealth preservation. Yes, this year it blew up, but definitely don't expect that to be the case next year or the year after that. Actually, next year possibly, especially with all these trade wars and things. But eventually, what I think is going to happen is after this big run up and after all these trade wars are kind of like settled, we're going to see some stagnation in gold for a couple of years as it catches up to the immense value that it's kind of brought. May also see gold price drop pretty significantly when everybody's fears kind of subside. I think gold is smart as a diversification in one's portfolio and a great asset to hold instead of just cash that'll die from inflation. But please curb your expectation and proceed with caution. If you're younger or you're still building that portfolio, you're going to get much more bang for your buck from the S&P 500 or a broad ETF with low fees long term. You can absolutely have a portion of your portfolio in gold. I just wouldn't be turning everything into gold based off of this year's gain. Okay, let's jump into some news because there was a lot that actually happened this week. AMD and OpenAI kind of broke the stock market. OpenAI announced plans to buy billions of dollars of AI equipment from AMD. Investors took the partnership to mean that AMD could become a viable challenger to Nvidia's current top position in the AI chip market. And speaking of AI, Elon's xAI and Nvidia seem to be forming a pretty solid partnership. Nvidia is set to participate in a $20 billion funding round for xAI, the AI venture led by Elon Musk. The investment package combines equity and debt, with Nvidia's contribution in equity reaching as much as $2 billion. Now, those couple of things really increased the market and made the stock market jump, but there was also a period of time this week where the stock market fell. It was a very volatile week, actually, because it went up and dropped a couple of times. The stock market took a little dip. leadership. Federal Reserve Chair Jerome Powell delivered brief welcoming remarks at the Fed Community Bank Conference, but did not address monetary policy or the economic outlook. Investors had looked to him for direction while the U.S. government shutdown freezes key U.S. data. Now, those Fed minutes from September are still pointing towards easing. Attention now turns back to that September FOMC minutes, where the in-house survey of Federal Reserve point toward additional easing this year, which means another rate cut. The vast majority of survey respondents expect at least 2 25 basis point cuts by year end, with around half expecting 3 cuts over that time. So here's what to watch in the next coming days. Key earnings reports and whether revenue or margin guidance holds up, comments from Fed officials on rate cuts or policy direction, any signs of progress or lack thereof toward ending the government shutdown, changes in sector leadership or signs of rotation, and very much what's going to happen with this tariff situation that just got announced on Friday. I would also be looking for new opportunities that are going to arise because of all this craziness. Like I said earlier, I use investing.com to start my research, and that's how I found APLD that's now up over 300% because of that research. They're having a pretty big sale going on right now with 50% off, but my subscribers that use my link below get an extra 15% off with my code only. You should check that out and then watch both of these videos because the stock market just keeps getting crazier and crazier, and it's very important for you to stay well informed. So do that, and remember to keep investing simplified.